All right, so we back with another one. First off, let's just go show the live express. So we passed the prop firm, right? It took exactly 1 month to pass the prop firm. I paid the $50 and I did not have to repay, right? I just had to pay the $150 to make this express funded gets live, right? So let's get right into it, right? The first day I took a $269 loss. Thursday I took two trades, $1 loss, and then on Friday I won $13. So I'm trading this live funded account very differently from all of the other ones because I have a tendency of just over trading, just trading, losing. So we're taking this right opportunity, totally different, and we're gonna trade the proper way, we're gonna trade the right way, right? So let's get right into Friday's price action, right? So this is Friday's price action. So we see we got a crazy just drop, right? So let's just break it down on the play that I was supposed to catch, right? Because I was mostly an observer on Friday, right? So what we get right here at 9:30 we get an aggressive move up. So matter of fact, at 8:30 it was 8:30 news this day, right? So this is the 8:30 high, this is the 8:30 low, right? So that's what we're anchoring the price action to. So at 9:30 it creates a bullish candle and then just aggressively comes up and sweeps the 8:30 high. Now, first thing I'm always looking for is the first presented fair value gap, right? That's what I'm always looking for from 9:30 to 9 whenever it gets created because it's you can use this first presented fair value gap as a key level. Now, so first thing we see, it takes the high, then we see some consolidation, right? Consolidation. Then we get an aggressive move down. Now, it was no entry in this move, right? And it's all about the context and the bias, right? You don't want to just get into trades because it just aggressively goes down, right? You want to have context, like the reasons why it's going down and an opportunity, and you can form an opportunity off of that. Anyway, so we get an aggressive move down, right? Now, it creates the first percent fair value gap right here at this 931. So I'm holding this as support, right? So the fact that it just breaks lower aggressively, right? If we're super bearish, you don't want to see the upper half of fair value gaps get traded to, right? So what we see here, it breaks below and then it stays in this lower half of this first presented fair value gap, right? It don't even have the willingness to come up here, to come up at all, right? Then what we get at 10 o'clock, we get an aggressive move all the way down. Look how aggressive that is, showing that we might be it's showing we are extremely bearish at the moment. And this is a 1 minute chart. So everything is just straight intraday. So now, what do I see here? How can I get in? One thing I know, right? In between two lows, there's a breaker, right? So I couldn't unless I wanted to just aggressively get in here. I don't like trading like that, right? So I like trading with context. So I was like, okay, where can I potentially get in at? I know the last line of defense is the breaker, right? So we got right here, we have a high, low, right? Higher high, lower low. It has to close below this low, right? So we see that. Let's zoom in some more. We see the close. See this candle right here? It opened up here, went all the way down here, came back up and closed right underneath this breaker. So now, high, low, higher, high, lower, low. It closed beneath here. This candle opens, comes up into the breaker, which is the most sensitive part of the breaker, which is this low to the open, the low wick to the open, right? Comes up, touches it, and it just displaced lower. So this is like, okay, I could have probably caught that play, right? Because these are the plays that I'm potentially catching. So I only do my market analysis on the plays that I catch, right? And then look what happens. So now it's down here. So you didn't catch this one. It comes down here. It sweeps it. But look what happens right after the sweep because it's so heavy, so bearish, right? It comes down, comes back up, and so look what it's doing. It's actually coming up into this wick candle, right? So you see this wick is using this wick as actual support. So I have the fib, I have my fib, me delete it. I have my fib drawn right here on it. So I got from the high of the wick, oh, use the wrong tool. Right here, fib retracement. From the higher wick to the open. So you see how it's staying, you see how it's closing all underneath the 25% range right here? You see how all of the bodies are underneath, showing that we are still bearish. It's still respecting bearish things because just like a fair value gap, you don't want to see it trade in the upper quadrants, right? In the upper level of a fair value gap. Just like this wick, we're using this upper wick as a inefficiency, right? So I want to see it stay in the lower half of this inefficiency, right? And then look what we get. We get aggressive close below here. Once it closed below here, this is the change in the state of delivery, right? Coupled with the fair value gap, which is the breakaway. And remember, if I'm heavy, I don't want to see the breakaway come back get traded to, right? After we close below the change in the state, right? Close right here. So we close literally right here. Came down this candlestick open, came back up in here to the fair value gap, which is the lower half. It's staying in the lower half. You could have called it entry right here. Put your stop right above here. Look what happened. Shoom. Right? So these are the plays that I missed. Right? And you see, you could have kept losing. You could have kept using the same zone. Look, same zone, same zone. It did not come take the high wick. See? It never came and swept it. So that's what I mean about using wicks as gaps. Anyway, so that was Friday's price action. So Thursday's price action, let's see what we get here. So at 9:30, we open down. First thing I'm looking for is the first presented fair value gap, but I'm still seeing what's happening because we have triple highs up here that got created around 4 in the morning in Asia. Triple highs, that's a magnet, and then we have some lows right here at 7 o'clock. So at 9:30, I'm looking for, okay, what is it doing? What is it going to do? Right? And I'm being patient and waiting for the first presented fair value gap to present itself so I can align it with my bias and my context. Right? So now 9:30 happened. We come down here. You see how we have a high right here and we have a low right here, right? It opened, came up, came all the way down, swept these lows first. Remember, manipulation. The market loves to accumulate, manipulate, and distribute, right? Which is the power of three. That's basically how candlesticks are like aligned and form. That's basically how candlesticks form. It open, it manipulate, and then it just goes the way it want to go, right? So it opens, comes down, sweep out this low. Then look what happens. Comes up, consolidates. Then it creates the first presented fair value gap. Then it comes, takes the high, right? So now we know that this is the target now. The triple highs up. These triple highs is the target because it already swept this low, right? So that's what I'm assuming the target is, right? Because we never really know what it's going to do. But you once it sweeps liquidity, it always reaches the manipulation in the opposite way where you're intending it to go. So I want it to go to the triple highs, right? But I know it's just not going to just go straight up there, right? It has to fake you out. It has to manipulate. So the fact that it left these relative highs intact, right? Remember, the market loves to do four things: create liquidity, right? Which is it's generating the liquidity, right? To give it a reason to come back. Comes down, sweep out this low. Now, this is the next target. Comes up, consolidate. This is the order block. Caught this. The first presented for value gap gets created. Right here, these three down closed candles is a bullish order block. Right there. Right, this is the bullish order block coupled with the fair value gap and coupled with the first presented fair value gap, right? So you could have got in right here, put your stop loss right here or at this low, right below the order block. So you'd have been safe right here. You see how you would came up, came back down. You could have caught your entry, bomb, swept out them highs. But look what happened. We're not done yet. Came back down, swept out this low, but it still never swept this order block, the low of the order block. right? So you actually wanted to take some profits right here and leave runners, right? You could have got another entry, came back, and you see how it's respecting this fair value gap. Like, look at the bodies, even though the wicks are down here, but look at the body. The bodies are closing in the upper half, right? Showing that yes, we're still bullish. Came back, order block, aggressively came back. Oh, and I actually forgot we have a breaker. I think we have a breaker right here. We have a right here, yeah, high, wait, low, yeah, right here. So we have a low, high, lower low, higher high. Oh yeah, that's a good one right here. So we got a low, high, lower low. Yep. Let me delete it. Let's draw this out right quick. Let's see. Let's draw this breaker out right quick. Let's draw this breaker out. Hold on. So we have a low, high, lower low, high high. So the most sensitive part of the breaker is the highest candle right here. So maybe I'll go here. You want it to stay in the upper half. So right there. So you see the breaker right here, right? So you see how it's staying in the upper half of the breaker. So we have a low, high, lower low, and it has to close above this high right here. So it closed way up here, right? So that's the breaker. You see how it comes back into the most sensitive part of the breaker? You see how it's staying in the upper half? Stops right here, comes back up, comes back down. Yes, the wicks do the damage, but the bodies tell the story. Look at the bodies. Oh my gosh, look at that. Look how the bodies is respecting it to the T. Look at that. And then order block, rally to take the triple highs. All right, so that's a play that I did not catch. Right, I did not catch that play. But you see how you can still use the first percentage fair value gap, right? You can just extend it and still use the level. So you see how it broke beneath, came back above, and then eventually right here at 12 at lunchtime, it came up. So I'm saying, so this was Thursdays. So anyway, I don't really want. I'm probably gonna go. Let's see, yeah. So you see how on Wednesday's price action, you see how the first percentage fair value gap. So you see how it's like a magnet. And eventually, with the right context, you could catch the plays, right? And we got a breaker right here, low. And this is why I love breakers. Like, I ain't gonna lie, I think breakers are like bread and butter because it's patient. It's the last resort. Like the breakers, it, I think the breakers is the best place because a lot of people want to catch them down here, which is want to catch the change in the state with the order blocking and want to catch the fair value. You know what I'm saying? Want to catch it up here, but if you could catch it up here, right? Your risk to reward is just magnificent because one thing about the breakers, you want it to stay in the upper half. So let me just show you. Because once it breaks below, the play is going to go back down here, right? So your risk is actually lovely. So we got the breaker right here. So we have a low, high, lower low, right? Lower low, and you got to close below above here. So right here, bow, right, breaker. So now let's extend. Let's draw it. The higher is where we go right here. Boom. Right? So now look. Low, high. Wait, sorry. You got low, high, lower, low, higher, high. All right. So you see how this is the breaker, right? You see all of this you see all of this that's happening, right? So now once it so you see this and then look, you see the fair so you're already expecting the breaker. That's the thing. You want to already be able to see the breaker because if you don't see the break, if you up here, you might be a little bit late, but you can still use it. So I'm talking about catching the breakers a little early. You want to already anticipate the breaker being creative, right? So once it's in here, you see that it's holding right here, right? You see this high. Now the fact that it has the wick, you can actually see to this day it didn't use the wick. It used the wick after it broke. So you see how it used the wick after it broke out of it, right? So we got the two down close candles, order block, right? But I'm talking about using it like, so now look, once you expecting the breaker to be created right here, right? Because of the context and all of the narratives, right? Now, you see this fair value gap that's created right here. Once you see this fair value gap created right here, right underneath it, you like, okay, hold on. This might be some support right here because you're already expecting the breaker to form, but you know that it's not going to form when you want it to, right? But you see this fair value gap, so you're all you doing is looking for another bearish candle, right, to close above to create the order block, because then you could just put your stop right here, and once it breaks here, you okay with it because okay, I'm wrong because the breaker is the last, basically like the last entry to kind of catch it, like the last late entry to catch it. So I'm saying, so once you expect the breaker to be forming, all you doing is waiting for it to like close above the open, right? So we get that close right here, and we get the order block right underneath. Now this is hindsight, but this is how you backtest and how you understand. Because I trade a breaker, so this is how I get better at trading the plays I take, which is order blocks, breakers, changing the state, which is basically the same shit. We have these bearish candles holding that support, which is the order block. Now we have the fair value gap underneath, which is the breakaway. Right? You have all of the context. Right? We already been consolidating. Right? We're at the high of the opening range gap, which is after 9:30. Right here. This is the opening range gap. We already swept the low first. We at the highs. We're consolidating at the highs of the day above the first position for value gap. Right? So we already did a lot of damage already. Right? Now, you see that once it broke above this representative fair value gap after the opening range, this is holding, right? It's holding. It comes up. Now it comes all the way back down and sweeps this. It might be time to run. So if you don't catch this one, it's up here, right? This is a balanced price range. This straight move down right here, this aggressive move back up, balanced price range because you have a fair value gap right here, right? You have sell side being delivered, right? And now we have buy side being delivered, right? Balanced price range coupled with the fair value gap underneath the potential breaker. Then we have the potential breaker. Low, low is higher. Low, high. I'm sorry. High, low, high, high. Damn, I'm tripping. The breaker is sorry, yeah, low, high, no. Damn, where the hell is it? Because the high is up here, so it go high, low, higher, high. No, high, low. I'm tripping right now. High. It's supposed to start with low. That's why low, low, high. No, it's over here. This is the A leg, so I go low, high, lower, low, high, high. There it go. Sometimes it go right. So it go low, high, lower, low, higher, high. Couple. So you got the order block right here. Couple with the breaker. Couple with the sweep. It's a lot, but this is how you make this money. So you gotta learn it. Anyways, you could have got in right here. Right when you see this, you could have jumped in. Right when you see this close above here, creating the order block, could have jumped in, right? You could literally put your stop right here below the breaker, right? Or at the upper half of this breakaway, risking 15 points. Look how much it ran. Being patient, right? Knowing that this day is just consolidated. You know what? I'm waiting. I'm waiting. I'm waiting. It's why it's a patience man's game, boy. Patience man game. But anyways, and then you see what happened. It never came back down here. Never came back down. So let's see. Let me draw a little fib from this low, this low to the high. The range is from here to the high. Boom. You see that? Didn't even have the willingness to come to equilibrium. Right? And look what happened. It stopped at this order block. Look at this. So look. So after the breaker, right? Aggressive move up, 3 down closed candles, a close above breaker, right? Let's draw this out. So let's see if it respects. Wait, no, wrong one. The most is bombed to open. Look at that. Didn't even have the willingness to come to the order block. Let's see. Let's see if where's the fair value gap? This one that didn't get right here. So let's see. This would be the potential breakaway. See? This one got tested, so it's not a breakaway. So this is the breakaway that you're expecting not to get traded to, because there's multiple fair value gaps, right? The closest one to equilibrium is one right here, either this one or this one. Ooh, look at that. Look at that. Stop right there. It touched this high wick right here. Got up out of there. Oh man. But anyways, man. So like I said, so we got on the prop firm right now. We down what $257 right now on the live funded. Right. So I wish I could go back to show y'all. It's not gonna be on here. How I passed it, like I passed it, man, without losing, without failing. Right, I passed the prop firm without failing the prop firm. So I traded that all the way from January 4th, and I passed it like the maybe like February 1st or something. Like I passed it like the last week of January, first week of February. So I passed it before my due date, and I paid the 150. So I catch you on a rebound, man. I catch y'all with a market review next week, and yeah, man, I ain't gonna be posting every single day. I just want to like focus in, right? Focus in. Trading make you ass insane. But and break this down. So now look, this is why you have to trade this prop firm differently, because it's a facade, right? You do not have a 50K account, right? So once you pass the account, right, it's the same thing. You can't lose 2,000. Instead of 3,000, you can't lose 2,000, right? So now I only have a $2,000 account, right? And for me to cash out, I have to have 5 positive win days of 200. Now I've done that before. I haven't done the 5 days, but I passed. I had 4 positive days of $200, two different times on 2 other prop firms, and I just didn't get to the 5th winning day to cash out. But we're trading this account differently because we can't over leverage, right? So this account gonna be a little different because I'm not gonna be over leveraged. I'm only gonna be trading with 1 or 2. So like this $269 loss is too much, because this is almost 20% of the prop firm. That's over leverage. You both only trade with 10%. So I can only base my biggest loser, because if I keep on having $200 days, right, I can blow the account within 2 weeks. So that's not smart, right? So I can only have basically like $100 loss. So my max loss a day is probably gonna be like 100, 150. Right? So I could potentially trade for a whole month, because if I go red the whole month, I'll probably fill the account around this day. So I just keep losing 150, 150, 150. But of course that's not gonna happen. So yeah, man. We'll check back in next week and we'll see how I did this week. I catch you on the rebound, man. And man, just keep studying, man. ICT, man. ICT concepts, bro. Let's get it.